Hello, everybody. Welcome to the State of the Market, State of the Market, State of the Market show. It is I, Andrew Giovinazzi, Director of Education here at OptionFit.com. For all of you that are new, 15-year market maker, floor trader, exchange member, been trading options for this year will be my 35th year. As hard as it is to believe. However, the last 11, 12 years, 13 years with Mark, teaching retail traders how to trade, showing you some tricks, tips, and things I've picked up along the way. Started when he was 15 years old. Yeah, I don't know how I look as young as I do, but I don't feel 60 yet. That's what I am. All right. So, state of the market, FOMC days. These are some, a lot of trading, I think, is observational, meaning you look at stuff. You look at stuff every day. I look at option screens. I've been looking at them for a very long time. Trading on the floor. You notice what things have a rhyme and a rhythm. So, one thing about FOMC days, as in what does it mean, right? So every once in a while here, so here's an example right in front of you here of the Fed is going to opine on interest rates. Now, when I was a young floor trader way back when, nobody cared what the Fed was doing. Nobody cared. This was pre-QE. This was pre-Great Financial Crisis. Basically, the market functioned like this for about 80 years. Markets didn't care a whole lot. QE, quantitative easing. Deficits, all that, they were there, government, but the government, when I was actually trading for a very long time, there was a shortage of government bonds. Hard to believe, but that's what it was. So again, at this stage of the game, we were going into kind of a disinflationary cycle in the 80s, 90s, into the 2000s. Interest rates are coming down pretty steadily from the early 80s. And then we had very low interest rates, and everything the Fed did, because they were doing this quantitative easing program, these kind of, let's just call it financial shenanigans. Everything the Fed did became more important. Essentially, the ship they were driving just kept getting bigger and bigger and bigger and bigger. So these days, what happens is we have the markets waiting for this announcement, waiting for this big announcement. The markets are very illiquid. Okay, now right now there's some liquidity, but as we get to the 2 o'clock time, right, 2 p.m., the markets get what I would call untradeable, meaning you just have to, the only thing you want to do from 2 p.m. to 4 p.m. today is close, meaning if you have trades on, and we'll talk about ideas here, but I have a surprise. It's mostly you want to put some offers out, like a good till cancel order, have working orders, and let the market go to them. Trying to chase and get in and all that kind of stuff, very, very difficult from 2 to 4 today. Things might calm down at 3:30 somewhat. But again, I think it's a very hard market. So today, weekly profit cycles, I'll be putting our trade for the day out around 12:30 today. Because for this very reason. So what happens is the Fed is going to talk about their policy. And since now they have the balance sheet is so big, the balance sheet being how much treasury debt the Fed has bought, their control over all these things. their announcements now have much bigger weight since this inflationary cycle that we've been in, probably for the last 2 years. Everything they do has such bigger weight than it used to have. It was rare that the Fed would talk and have a market moving event. I really only remember 2 in 15 years as a floor trader. So that's, 2 out of over 100 times where what they said actually was a surprise to anybody and really made a difference. So what I've noticed though, in this, what we'll call inflationary cycle, this is from probably 2022 till now. I'm going to take you through the last 6 Fed announcements. So, and how this could help you plan yourself for a trade coming after this announcement. So basically what happens with the Fed is they're going to have a press conference and then they release the minutes usually around a month later, where they actually, you get into the nitty gritty of what all the Fed guys were talking about. So here you can go to the Fed's website, and you can get this information just when the next Fed date is. If you trade volatility, if you trade the SPY XSP, you trade the Russell, all these major indexes, any stock, these days you're going to get, it's going to affect all of those trading products. So again, July, so the dates we're looking for in 2024, I got July 30 to the 31st, 17, 18. Then this was right after the election, I believe, right around the election time, November 6, 7. And then December 17, 18. And then what they actually said is released about 3 weeks to a month later. So they're going to say what they're doing with rates now, and then everybody's got to wait for a month. And then they get into a stack of how many of the Fed governors liked the idea, didn't like the idea, and they break down the whole minutes that they release. So this function that they do here in general is a liquidity dampening function. Basically, they're going to have their rate announcement, let things calm down, and then everybody can read, what they were thinking of after the fact. But what I find interesting for us as traders is what the market actually does around these announcements. So I want to go through the last 6 Fed announcements and just say, hey, is there something we could divine from all this, all this Fed action that could be a way to lean on a trade? When I say lean, meaning I want to be a little long or a little short. But the key is, do we really want to do it after the Fed, before this Fed speaks, or do we want to wait to see after the Fed speaks? So we'll see kind of what we've got out of that. So real simple. This is July 30, 31, the Fed's meeting. The infamous trade now or trade later. It's the wimpy trade, right? I'll gladly pay you now or pay you next week for a burger I can have today. Something along those lines. I got to get the line right. So the first thing is, so here you have August. So this is a SPY here. And I just circled kind of like the into the Fed. Into the Fed. So what we had is we basically, I shouldn't say low here. I should say the SPY high there was 538 going in. So this is the 31st. Everybody's feeling pretty good. But then postly, gladly pay you Tuesday for a hamburger today. Does everybody have a friend like that? I think everybody has a friend like that. Somehow they're always in your car. You're always buying them something. So what you have is you had kind of the run, but it wasn't necessarily the run into what they were saying. But then the market, now remember, the market was very soft, if you guys remember. And then post news, the Fed had that Thursday, Friday, Monday. So actually, after the Fed announced what they were saying, the trend was actually down, and that's the one you really wanted to follow post-Fed. Seeing, at least for this case, they talked July 30, 31st. Okay, the market was peaking, and then it totally fell apart. So this was July 30, 31. And another thing I want you to notice is the range during this, we'll call it 5-day period. So you've got a couple things to look at here, right? So as you're going through this, okay, we're going to look at like a 5 to 7 day period into and out of interest rate announcement. Okay. And what we want to see is the range, how big of the move, and then the next thing we want to see is ultimately the final direction. Okay, is there anything that we can kind of pull out of this? So the first thing you want to figure out is, now this move over from, like, say, July 30th to August 5th, I believe, about 3 to 4 trading days, was 28 points in SPY. And the price of the straddle, which is the call and the put, for the week was only about $12 or $10 at the time. So the market moved almost 200% of the expected move. Pretty major underpricing. So the liquidity providers, remember, they're always, the liquidity providers are who's putting up the markets. They're the ones that are responding to prices. They're responding to people trading in this room. They're responding to funds. They're responding to what they see on the news. They're responding to order flow. So the idea is, just because it's priced there doesn't mean it's right. Okay? Just because it's priced there does not mean it's right. So you have a $28 move in about 5 days, and the market was pricing about a $10 move. Let's roll to September. Again, here you had a mid 17, 18, a couple days here, and then you had what basically was, if you're looking up here, right, a very strong up move post Fed. So before, you had a very strong down move. We stayed that way till we had that basically parabolic bounce after we had that carry bomb happen. But we were down 2 days prior to that. Here, we're getting a lift, but the market ultimately stayed and kept going higher and higher post. So the September 17 to 18, again, we're waiting for the election, but we had a 12-point move over our 5-day period. And this is just from basically the bottom to the top. Again, the market was pricing around a $10 move. So here, it wasn't as great an outperformance, but ultimately the market kept going up and up. So this was September of 2024. So you had the Fed spoke, and then really what happened into the Fed meeting didn't matter as much as the run you had at the end. So you probably, from the first two, you would have done better ignoring what happened on the Fed day, at least from the first two examples, and wait till Thursday for a trend, right? Because normally they talk on a Thursday or on a Wednesday, say their thing. And then you have Thursday, Friday, Monday, Tuesday, Wednesday of the next week. So here, again, the trend kind of got strong and picked up. And that was around 20 points or so. I'm sorry, this one was around 12 from bottom to top. Here, again, we had the election, but low on this frame was 570 to 600. Now this straddle was a little more around 12 to $14, as I recall. And you had your Fed speak, and then we had, well, basically we had the election and the Fed, and then post Fed, everything kept going and going and going. So that whole range was almost 30 points. So again, you had you had whatever was going on prior, and then all of a sudden the trend took off post Fed. So we have like a strong case in recent history for the first three where Fed says whatever they're going to say. There's a lot of uncertainty that day, meaning the Wednesday. And then the trend starts to pick up. We have two uptrends and one downtrend so far afterward. All right, let's go to December 17 and 18. Again, this one was a little odd. We had an odd, it was a bond market. I don't remember exactly from an interest rate point of view. But again, the real story didn't develop until post announcement, where we had, again, another strong up move. But there was nervousness prior to the Fed spoke, people calmed down, and we ripped again. So you have this kind of combination of a lot of uncertainty before, anything can happen. The Fed speaks. There is some sort of continuity and confidence because they're saying this is what we're going to do. And then the market takes whatever that news is. If it reads it as good, you have a continued 1, 2, 3, 4-day rally. So Hannah's saying basically for a few days for things to shake out and the market picks a direction. Any way we can know which way. So you want to wait. Well, ultimately you can have a two-way trade where you just put it on and you just wait to see which way we go. Or you're waiting till Thursday when you actually see which way the market decides. Or you just put on a two-way trade prior to and you wait 5 days. A two-way trade does not care which way we goes. You just got to sit on it and let the market do its thing. What I want to point out to you is the ranges you get afterward. Okay? And out of. Okay, you have a 20-point move in SPY. You have a 30-point move in SPY. You have a 12-point move in SPY. You have a 28-point move in SPY. Pretty big moves after the Fed. So these were for 2024, the last four. So the point I'm making is the noise in front of, like even we're getting today, if you look at the action today, right? So we're a little up, right? Mark, I would say, hey, we're expecting a little bit of dovish talk. The market's a little bullish, but you won't know until when? Until they talk. After 2 p.m. Now, also, VIX trading 24, zone 4. That's a very volatile time, right? It's the highest quartile of volatility for all of you that picked up my zone talks from last week here in State of the Market. Somehow we got back to this, right? We're now back to a zone 4. That's basically the market saying, hey, we don't know what's going on. So today will not be resolution, in my view. The resolution is going to come Thursday, Friday, Monday, Tuesday, like the next 5 trading days. So what you should take from this is you've got noise in the front. Sometimes the noise can be huge. Fed speaks. We get a direction. We have 3 up, 1 down so far. Now, in 2025, we have had 2 Fed meetings. Again, same pattern. Fed speaks. Then they release all their little goodies afterward. Again, they're trying to dampen the volatility of what they're doing, meaning less market impact. Because the Fed by now has to realize they are creating huge market dislocations. Of course, the current president is doing that as well. So we only had 2 dates so far in 2024, in 2025, and let's see what happens. So on Jan 28, we had noise into the market hears what's going on and then totally erases, right? We had that big drop and then boom, 4 days up right in a row afterward. So our range here is 9 and 6 is 15 points. So what this is, again, giving you a sense of the Fed can speak or there's noise before, but until they say something and give some kind of clarity, then all of a sudden the market takes whatever that is and runs with it. Really and overall you can, we've got 5 out of 5 examples, 5 were pretty bullish, meaning they basically like what the Fed had to say. Last example I want to give you here, and this is I would say a little more muted, but not too much. And the reason is this Trump the tariff thing had been hanging over the market for quite a while here. However, from a range point of view, again, moving into this, the market looked very weak. Everybody's a little nervous, right? Don't know what to do. Uncertainty. What does the Fed do? They say what they say. Rates are going to do this. This is how we're feeling. And then you have here, again, a pretty solid move up. 558 to 575. This is around 17 points over the last, 4 or 5 trading days. This one may be stretched to 6. So the point is, the show is not today for looking for a trade. I believe the show comes in the 5 days after, 5 to 6 days. So you'll be trading Thursday, Friday, the trade you want Thursday, Friday, and then that could stretch as much into next week. So today's noise will have very little to do with what happens Thursday, Friday of this week and into next week. That's what the last 6 Fed announcements have told us. So setting up for this, like what we do in our products, like I do in weekly profit cycles, is just I set up a two-way trade meaning market goes up, we ride that, market goes down, we ride that. Close what pays and see if we get a move the other way down the road. And that's the perfect way to trade this. So if you want to trade a flyer meaning I just want to be long or short, wait till the direction is set Thursday midday. We looking good, we looking terrible. If you want to just trade a flyer. Hard to hold an overnight flyer, meaning hard to hold an overnight long or an overnight short. So you can wait till tomorrow and see what kind of trend develops in the morning, and that trend should follow Thursday, Friday, Monday, Monday to next week. If you don't want to do that, you trade with weekly profit cycles. I'll just go real quick here for the last couple minutes. Right? So basically we set up two-way trades. And the whole point of this strategy is I expect a 2% move in a month, and we should be able to generate a gain on a 2% move. Now, February and March, we've had almost 2% moves every day. Also, the point of this as a strategy is we are way over 2% every Fed meeting. So the weekly profit cycles, and they do very well through the Fed meetings because we can hold for 4 or 5 days easily and then exit the gaining side. So the whole point of the strategy is I want this big move. I want the big swing. Right? We've had some good gains on the sell-off. And again, my students have done very well over the years in weekly profit cycles. And somewhere here, you can grab an order form and everything. It'll probably be posted to the room. But the easiest thing to do if you want is give that a try and see what you get. So I put all my own trades on in weekly profit cycles. And likely, even today, if you sign up, the trade will most likely go out at 12:30 today. Because like I said, trading into 2 o'clock, too difficult to get anything on. But I expect this kind of, and until either the inflation situation chills or the government spends less money, these are the kind of moves you're going to have around the Fed, and it's hard to get away from them. Because the market just lives, once it has that piece of certainty, it rides up or rides down. Remember, when the market thought rates are going up forever, all we did was go down. Down, very volatile. So we'll see what happens here going into today. And Mark will be on live at 2 o'clock as well. So any questions about weekly profit cycles, what you think of this, seeing basically the last 6 Fed announcements? Did it surprise you that the market moved as much and picked a trend post-Fed, right? So the action you got at the beginning of the week is not necessarily and could very well be different than what you get at the end of the week, meaning Thursday, Friday, and the following days to next week, right? So the market lives on that positive sentiment and basically, the confidence that the Fed is saying what they say what they're going to say, and then all of a sudden you have a good direction and a confident direction for traders, either that's up or down. And right now, 5 for 6. All right. There it is. If you want here is the order form for you. What do you get here? Weekly profit cycles, all kinds of stuff. Trade dossier. There's so much stuff in this product. It blows my mind, to be honest. But I teach it 3 days a week. And Hannah posted a link here. And we had a great trade actually last week, and I think we'll have a great one today. Should we take action on positions already in our portfolio? Enzo, I don't even know what that means. In weekly profit cycles, in your own portfolio, like that is a very general question. Weekly profit cycles, we will have a trade out by 12:30 today. And there you have it. Dump options prior to Fed speak. Again, it just depends on what you got on. All right, everybody, have a good day.